Hey, it's the Profit Answer Man, Rocky Lalvani. If you're new to the podcast, check out my interview with Mike Michalowicz. It's episode number 2. If you want to hear about each chapter in the Profit First book, go back and listen to episodes 3 through 13. Episode 1 is the why and how. On the Profit Answer Man, we learn money mastery without all the complicated accounting mumbo-jumbo using a simple system. Your accountant is busy documenting your transactions and creating a rearview mirror of what happened. My guess is you don't even look at the reports they sent you. If you're like most business owners, you struggle with this, and it's not your fault. We aren't taught money in school, and accountants aren't taught how to be profitable. The Profit First system created by Mike Michalowicz works, and he certified me to help you implement the system in your business. Remember, the new equation is sales minus profit equals expenses. Let's face it, without cash flow, you can't pay your employees, buy needed materials, or pay your mortgage and support your family. I help you to do that and more, so you can focus on the parts of the business you love and receive the rewards for your labor and investment into your business. The stronger you are as a business owner, the more jobs you create, the better we are as a country. Small business owners are the backbone of America, and for that, you deserve to be well rewarded. Just remember, more revenue does not equal more profit. That's why we focus on the bottom line. Hey, inflation is becoming real. What are you doing to prepare and be ahead of this curve? Some of my clients are ordering in extra inventory at massive levels, if possible, not only to deal with supply chain issues, but constantly increasing prices. They're also increasing their prices and making sure they are proactively updating systems with the current information so they don't lose money. You have to keep up on this. It takes time. It's got to be on someone's calendar, someone's action list. You're also comparison shopping as well, because maybe someone else isn't keeping up with the changes and you have an opportunity. Maybe you team up with some others to get pricing power or to buy even larger bulk quantities. There's so many creative ways to think about it. It's also affecting their labor costs. So doing your best to hold on to employees and find ways to attract more people and not making money the deciding factor. Because just paying more for labor doesn't mean you're going to get better people. Today's world, they want something more. Take the time to think through this, or it will come back to bite you. Today, we have another Profit First success story to share. Getting naked with your numbers and facing the reality of what's going on in your business is not always easy, but the results of doing that will help you to be more profitable. Listen in as Adam shares his story. By the way, we've got a surprise at the end. Adam Lendy is a real estate broker, investor, and business coach who saw the investment potential in RV parks. When Adam's not helping investors grow their wealth, you're likely to find him flying high in the sky on his paraglider and spending weekends in his travel trailer. Let's meet Adam and hear his story. Welcome to the Profit Answer Man, Adam Lendy. It's great to have you join us today.
Glad to be on here, Rocky. Thanks for having me today.
Can you share a little bit about yourself and your business?
Sure, absolutely. My business, I'll start with the present and then I'll kind of build to it. I am a co-founder of Happy Camper Capital. We are an outdoor hospitality investment group, meaning that we, get friends together to invest in RV campgrounds, resorts, and marinas. Kind of what brought me here was, I'd say it was a background and a love for real estate. Started as a real estate investor back when I was a police officer. I spent a decade in law enforcement. Real estate is what brought me out of it. Having some investment properties I owned, and then also getting into brokerage, realizing that, brokerage is highly transactional, and at least I didn't see a path that I wanted to pursue and making that something big. And then, through a friend of mine who I knew, who, we like to play outside with our hobby of paragliding, we got into this business of buying campgrounds.
So I'm assuming you love what you do.
I love what I do. It's, it doesn't feel like I'm working.
And that is the appropriate place to be, is to kind of figure out how to put those together so that you can do that. Not everyone gets there. And I guess that was a big shift for you because you came from law enforcement.
Correct. Yeah. It was a total shift. Maybe the technical skills in law enforcement weren't transferable. I'd say there was some stuff that I took away from it, as far as, discipline and, I guess maybe it's really helped, build my character and my integrity, and, which I think is really helpful when I'm working with investors and investing their hard-earned money.
Sounds like everything worked out well for you. So we're here today to talk about Profit First, and you've implemented it within your business. Just love to understand, before you implemented Profit First, what was it like?
Well, so I implemented Profit First when I was a real estate broker. And prior to, I think I did what most business owners do, which is I had a checking account, and all my commissions went into the checking account. And I was diligent about taking a chunk out for taxes every time and squirreling that away. So in a way, I was I was at least doing some level of distribution, but I was doing it on a check-to-check basis, which in real estate brokerage was very inconsistent. You might go 3-4 weeks without a closing, and then you have 6 of them in a week. And I'd go through for each check or each couple checks I deposited, and I'd pull some taxes out. But other than that, I put it in the checking account. I would decide an amount that made sense to transfer to my personal checking account, just to cover expenses and produce income, but nothing that was really consistent. So I really didn't have a measure of how my business was performing.
And I will say, I've talked to a lot of real estate agents. Most of them don't do what you did, which is to put money aside for taxes, especially in the beginning. And usually after that first year or two, there's that shock when the tax bill comes, because for most real estate agents, I mean, it's not unusual to get hit with 25% of your total income having to be sent into the feds.
Yeah, and I fortunately had a leg up. I had somebody else in the business, of course, give me that advice. And the advice they gave me was to hold a third of my checks away. So I did that. I held away a third. And it turns out I was saving way more than I needed, but much better to be in that position than the other way.
So how did things change with Profit First?
Well, I guess the first thing was it brought some awareness, right? Because when you, and of course, I didn't maybe do it the best way the first time. I just, from the book, followed the cap to tap table. And I didn't really have a clear idea of what my caps were because I wasn't in good relationship with my P&L at that time. So I just kind of shoehorned myself into a starting point and, realized very quickly that, my operating expenses were a lot lower than they were. So, obviously it caused me to go back to the drawing board and say, okay, well, I can readjust this now. And that's when I really started getting intentional about my P&L and keeping it up to date and knowing where my expenses were. So that way I could, I guess, know what to focus on, know what my trends were doing under each of my headers, so I could succeed in lowering that OPEX so I could improve my profit and my owner's comp.
And I'm assuming it turned out well?
It did. It turned out really well. I had, when I left my real estate brokerage, my caps for profit, I had set at 5%, and I had my owner's comp set at 60%. So I'd say that was pretty good.
You were taking a good chunk home.
I was running a very skinny business. I had 20% for OPEX.
Did Profit First give you that kind of aha to say, hey, I'm going to run a skinny business, or was it something else?
It absolutely did. I mean, you hear all these adages and everybody wants to sign up for whatever the, service of the month is. Of course, everything nowadays is a subscription, and that's what we have to watch out for. All the software is a subscription out there, all these monthly things you forget you signed up for, $10, $15 items, death by 1,000 cuts. And people say things like you have to spend money to make money, which I hate when people say that, because you have to invest money to make money. You have to get an ROI on those investments you make. So no, it absolutely. I mean, I was making enough money as a real estate broker at the time that I was really able to offset a lot of the frivolous expenses I had in there, these fringe expenses I didn't really need. But it becomes addicting as you start doing this, and you need to learn how taking a percent off the OpEx gives you a percent to put somewhere else. And you really start looking for ways to renegotiate contracts, cancel things you don't need, get those expenses down.
It sounds like you turned it into a game.
100%, enough that I actually inspired my wife to implement it in her business.
Oh, cool. How did it go for her?
She's still working on it. I mean, she loves it. She actually, on her own, and she hates this, by the way. And I will say this, there is a lesson that I learned in this. I got her started by doing it for her, which did not do her any good. She had no idea where her money was going. I was running her distributions for her on the back end. And even worse, I was coaching her on asking her why her expenses were higher and telling her how she should lower them. And those aren't conversations you should have with your spouse. Good advice on that side. I ultimately turned the reins over to her, taught her the process, and she does it on her own. And she's very, very diligent and disciplined about getting in there on the 10th and the 25th and running her allocations.
Well, congratulations. And congrats on being smart enough to step away.
You gotta know where those boundaries lie with your spouse. Yeah.
So you said something interesting, because I know this is one I think people struggle with, right? You have to spend money to make money, and I don't believe that either. You said you have to invest money. And so you're expecting a return on investment. When you make a decision, how do you figure out your return on investment?
I every time I make a spending decision, that's always the question I ask myself is, what do I expect to get from this? And it may not be monetary, maybe time. So there are some investments. I, for example, hired a VA recently who manages my inbox for me, because I am not the person to run an inbox. I'll tell you that my unread count on my email has a comma in it. So I hired this, VA. So there's not necessarily a direct link to my profitability there. There will certainly be an indirect link. So measuring that is going to be very difficult. It's going to be from the opportunity afforded me to do other things.
Well, I think you can measure it directly, in the sense that if you were spending 10 hours on your inbox and you're now spending 1 hour on your inbox, those 9 hours have value. Right. And I tell most business owners, you should know what your hourly rate is, because once you know what your hourly rate is, it becomes very easy to say, should I hire a VA? Well, the VA is X amount, and my rate is this amount. So yes, hire a VA. Or I'm doing this work in my company that someone else could be doing for $30 an hour. Even though I don't mind doing it, the reality is if my rate is $150, then turn over the $30 work to somebody else, but make sure you're doing the $150 work. Don't say, I'm turning this over and going to the beach unless you're in the financial position to do so.
And in that case, that's a justifiable investment for me personally. At least at this stage, I will take those investments that afford me time with my family. So, that again, that's the ROI. That's the immeasurable ROI.
Well, if you've built a good business and you have enough money to run your lifestyle and everything is going well, then I think time freedom is much more valuable than a couple more dollars in your bank account. And if you can get time with your family for $30 an hour, you're never going to get that back with young kids. So, I mean, it's a very teeny price to pay.
They grow up quick. Absolutely. It's finite time.
That they do. And so you have to make use of it. One of the things you said to me before was that it allowed you to have a better relationship with your P&L. What did you mean by that?
Well, before, the only time I ever produced the P&L was if a banker asked for it. We need it sometimes for the financing in our deals or to get a personal loan. I need it sometimes. So that was really the only time I'd ever generated a P&L. I'd hastily throw in together, not put a lot of effort into it, and really didn't process what the data was doing. I didn't need to. I knew I was making enough money to live on, and I was comfortable with it. But like I said, for me to understand how to shift those allocations in profit first, I had to know where the money was going. I couldn't just use the credit card balance, the business credit card balance at the end of the month as a guide. I had to know what made up that balance. So it really forced me to get in and sort my headers out on my expenses and, be able to track my trends to know if an expense went up, if one of those subscriptions or a service that I used went up in price. I let me actually focus on it and then know if I need to address it.
And you'd be shocked at how often that happens. And people blink an eye and all of a sudden there's $1,000 a month going out in subscription services very, very quickly. And there's multiple this and multiple that. When I dig through their expenses, I'm like, why are you spending all this money? Like, we don't know. We didn't even remember we had all that stuff.
Yeah. And that's how they get you. They get you on this auto renewing and you forget about it, especially when it's only $10.
Yes. And unfortunately for a lot of these people, it's a lot more than $10 and it quickly escalates and goes up from there.
Yeah.
So do you implement any of the, maybe not specifically profit first, but these principles? How do you do it in your deals as you look at real estate? Does it change the way you think about how you acquire properties and manage them?
Actually, it plays a huge role. So when we purchase the properties, in commercial real estate, which is the space we're in, the properties are evaluated using a capitalization approach, which means it's based on the net operating income of the business. It's not based on the value of the land and the improvements like it would be in any other type of real estate. It's truly on the performance of the business. So we are in P&Ls every day when we're underwriting properties. And we see owners who have way too high of expenses, and that's an exciting opportunity for us because we know we can go in and just making some operational changes, improve the profitability and ultimately the future value of the property. So that's a huge part of our business. And then, of course, when we get into the operations side, making sure that we are maintaining profitability so that we can give our investors great returns. And again, like I mentioned, because that will directly correlate to the future resale value, keeping the value high.
There's a hidden gem in there that I don't think people realize. So if you're walking into a poorly run deal, it's actually good for you and you appreciate that because you know how to bring the spending down and in line, which it's a massive multiplier in real estate, right? So if I'm buying $1 million building that's poorly run, how much could you turn the $1 million into if you fine tune? And I know it's kind of a guess, but what's a range?
Well, I mean, let's play with it. Let's do this just for fun. I mean, so when we're coming up with the value, right? So to get the value of the property, so let's just use your example that it's $1 million property. And if we're using a capitalization approach, so we don't get to determine the cap rate. The cap rate's determined by the market demand. So, for example, an asset, say multifamily, commercial multifamily is typically going to be somewhere around 4 or 5%, although that's getting more compressed than anymore. But, to hit that, or I guess to determine what the net operating income is, you take that percentage of that purchase price. So if you see a property listed at $1 million, if you were to take, say, 5% of that, you'd be $50,000. That would be the net operating income of that property if that's the cap rate at which it's sold. You can reverse engineer that by taking the net operating income divided by the percentage, of course, which is going to give you what the value should be based on that capitalization. So if you were to know that your net operating income was $50,000 in that case, and if you were to find a way to double it, you would be doubling the value of the property if the market demand was still that same 5%.
So from going from 5 to 10%, right? You're taking $1 million property and turning it into a $2 million property.
Going from 50,000 to 100,000 net operating income. The 5%, if we're talking capitalization,
we were talking, yeah. So yes, but 50 to 100,000, and you go from 1 million to 2 million.
Right. And if you figure a good business, and I'd say, and I can't speak for all assets. I can speak for my industry, which is the campground industry. We typically see, a properly run campground is going to be between 50 and 60% expense ratio. Because these are heavy with employees and staffing. It's hospitality. So if you see it skinnier than that, they're probably skimping on something. If you see it heavier than that, again, ripe with opportunity.
And I'm not that familiar with the hospitality. I'm more familiar with the buildings.
Right.
But if I looked at that original deal, and the million might not be the right number that we're working off of, but it's easy math. If I raised rents by 5% because it's undervalued, I would double the value of the property.
You could effectively get closer. Yeah. If you at the same time kept your expenses down. Yeah.
It's always about keeping expenses down.
Absolutely. So yeah, that's the beauty of commercial real estate. It's all in how good of a business you can run.
And so it seems all the more important to be very careful. And that's the other thing, that with commercial real estate, you got $1 million building, you have multiple doors. Everything you do is multiplied by X.
Correct.
In other words, if you can cut a cost per unit by $10 and there's 50 units, now it's $500. And you do a couple of those, and in no time, it's making a massive, massive difference.
Right. Now, and the other nice thing about it too is, and so we're in obviously the outdoor hospitality space. So we don't necessarily have doors, we have sites. Yes. So RV sites, tent sites, and whatnot. So our expenses are a lot leaner in that regard. They're just a little heavier on the payroll side. So, we still look at different ways we can negotiate services down with contractors. We're always looking for ways to increase the top line revenue. And that's the beauty of this, is we have a lot of opportunity there. So really we have a push-pull approach to get those values up. And the big thing it's exciting, of course, we talked about those cap rates based on market demand. They're compressing in a lot of these assets. So like I mentioned, in commercial multifamily, they were maybe 5% a year ago. They might be 3 to 4% today, depending on the market. Our industry was about 12 to 13% 2 years ago. And if you can find them 8 to 10% today, that's good. So just by the nature of that cap rate compressing, your value goes up. So if you can also, while that's happening, improve your profitability, sky's the limit.
So because there's so much compression, are you thinking of walking out? And
I'm not, quite the contrary. I'm thinking of buying more. That compression is a good thing for our values in the long run. Because what we're doing is we're determining our value by dividing the net operating income by that percentage rate. So as that percentage rate goes down and you're dividing by it, obviously as the denominator, your value goes up.
Correct. I just meant if the trend reversed.
Oh, if it went the other way. So if the cap rates increase, that would show a lower demand in that asset. So if that were the case, yeah, we'd probably consider a pivot.
Okay. And you always have to be open to the pivot, right? I think that's a big part of business.
Correct.
You also have a podcast, and it's called the Wealth Watchers Podcast. And thank you for having me on.
Absolutely. It was a pleasure having you on.
Tell us a little bit about what you do there and how you help people.
Yeah, well, and I'll give you a little background on the podcast and how it came to be. So I have a coaching background. I've got a coaching heart. It's one of those things that you can't get rid of. I know you probably share that same experience. Once you got the bug, you want to be able to help people. I had my eyes open to, being aware of net worth a few years back. And it was one of those things that obviously I believe that whatever you focus on expands. And, so obviously focusing on your net worth and improving it will naturally cause it to expand. So much like Profit First being focused on your books will cause them to improve. It started actually as a meetup. We started here in Denver, Colorado, to get people together. It was based on a concept I took from somebody else who had started a supper club to make millionaires out of them. It was a group of people. We used the net worth tracker. We tracked our net worth. We showed up every month. We shared our goals. It was a group accountability method. So obviously we wanted to be able to expand that influence. So we created the podcast as a means of doing so, with a focus on business and money. And now, obviously, it's somewhat connected to what we do at Happy Camper Capital, because obviously, if somebody has a higher net worth, it opens up to more investment opportunities. So there is maybe another motive in there, but obviously, the ultimate motive is to help people.
And you mentioned something interesting. When you get together with a group of like-minded people, you set goals, you hold each other accountable, you are much more likely to achieve your results. But it also requires you to essentially get financially naked. You didn't seem to have any issues with that.
Well, actually, we did have a little bit of issue. We had some growing pains with some people who showed up, because I'll tell you this, people are at all different stages. And we welcomed anybody who wanted to come in, whether they had a high net worth, a low net worth, a negative net worth. In some cases, everybody was welcome. However, some people felt very vulnerable. It's pretty hard when one person's in the room with a $5 million net worth and you realize yours is $50,000. It can cause some uncomfortable feelings. So the way we curbed that was, asking people to not necessarily share their number, but share their number in terms of percentage of what they'd like to see done in their goals. So maybe they didn't want to increase their net worth they shared that increasing their net worth by $10,000 would be meaningful to them, but they said a 20% increase in their net worth, right? Knowing that at least that we had a way to measure their success and hold them accountable was what made the difference.
Interesting. So I was just at GoBundance, and they get financially naked, and let's just say it was a much multiple of the number that you mentioned at the top end. Now, to walk in the room, you're not walking in the room without at least somewhat of a net worth to begin with. But that is the issue. People look at some of these numbers and they are jaw-dropping. But here's the thing. If you can get in a room with someone who's doing 10 or 100 times better than you, and they're willing to help you and teach and you can learn, that's how you're going to get 100 times better. And so you shouldn't measure where you are compared to somebody else. Measure where you are versus where you are, and being the dumbest person in the room is the smartest place to be. So it's always nice it pushes you forward, and people will show you. And I think this is where people don't realize it. People who are successful want to surround themselves with successful people. And so they're willing to help you, support you, and pull you up as long as you're willing to do your job and show up and do the work.
Agreed, completely. And I agree with the sentiment of what you said before there too, is I definitely never want to be the smartest person in the room. I always want to be chasing behind somebody else and have somebody, whose taillights I'm looking at.
That always helps us to improve and grow. Is there anything else we should have talked about today that we didn't get a chance to?
Rocky, I love talking about profit first. Like I said, I kind of geek out on it. As you know, I have a background in business coaching, and I've shared it with my clients. I've shared it with my spouse, incorporated it into 3 different businesses of my own now. I'm a firm believer in it, so I'm just happy to be able to share my experience in hopes that it helps some of your listeners grasp the concept.
And you did it on your own, just reading the book, correct?
That's correct.
All right. I just want people to know, you know what? You can just pick up the book. You can read the book. You can go back to episodes 2 through 13, 3 through 13. We tell you everything in the book. There's no things hidden behind the curtain, right? It's not, you need to pay an extra this amount of money to get the secrets. Everything's out there. It's public knowledge. We just encourage you to go do it. Start somewhere, make little changes, and start your way to being profitable.
Yeah, the book is a cookbook for success as long as you follow it.
As long as you follow it. And that is where we get struggles. People don't seem to, they don't want to read, or once they read it, they don't want to take action. They struggle with getting the bank accounts open and then doing their allocations. But take baby steps and just keep improving. And little by little, you'll get there.
The book gives you the easiest way to get started. Just that one account, just that 1%. That's all it takes.
Yeah. One account, 1%. And little by little, continue to add in and do that. And you will achieve success.
Absolutely.
If people would like to learn more about you, Adam, find you, what's the best way for them to do that?
They want to learn about me personally. I'm on LinkedIn. Adam Lendy. That's Lendi. They can also email me if they want to chat directly to me. It's adam@happycampercapital.com. Our website is the last part of that email, of course, happycampercapital.com, if they want to learn about our investment group and what it is we do. And of course, our podcast, as you mentioned, is the Wealth Watchers podcast. And if you'd love to hear Rocky on our podcast, that's episode 74.
Thank you so much. It was enjoyable to be with you then, as it is now.
Pleasure's all mine, Rocky. Thanks for having me on.
Thanks for listening to today's episode of The Profit Answer Man. My name is Geeta. I'm another one of the Profit First professionals on the Profit Comes First team, and I'm going to be taking over the closing section for this podcast moving forward. This will include the same summary that you're used to hearing, in addition to either a key question for the week or a key action step that you can take for the week to improve as a business owner or to grow your business. One key part of today's episode with Adam is how operating expenses factor into your bottom line. Operating expenses can be a difficult area for business owners to dive into on their own, and especially to be willing to share with others, even if both of those would lead to more profitability. This week's action challenge is to do an audit of your expenses if you've never done one or if you haven't done one recently. What recurring expenses do you have that aren't generating profit? Are there things that you're spending too much money on for the industry that you're in? Today's episode includes 3 tips to help you with an expense audit. The first is to consider it almost like a game, like Adam and Rocky talked about earlier. Games are fun, and this helps shift your mindset to make the process easier. Secondly, remember that you don't have to spend money to make money, but you can invest money to make money. This is a key idea because investing into an asset can help your business grow, but spending money just for the sake of spending money rarely leads to a larger bottom line. And lastly, and this applies beyond just evaluating your operating expenses, be willing to ask for feedback. Is there a local group of business owners that you can talk to about your numbers? Are you willing to be honest with them when you do that? And don't forget, you can check out Adam's Wealth Watchers podcast to learn more about what he does.
Hey, it's Rocky. Don't forget to check out my other podcast, Richer Soul, where we talk about life beyond money and how to live that ultimate life and become a better leader in your company. As we close out, let's repeat the mantra. Revenue is vanity. Profit is sanity, and cash is king. Have an abundant and profitable week.